Welcome to the Capital Connect podcast. My name is Ben Haber, and I'm the co-founder and CEO of Monark Markets, an API infrastructure connecting brokerages, custodians, and wealth management platforms to private markets. On Capital Connect, we take a deep dive into the most interesting and timely topics in private capital markets with the most informed and intelligent guests in the ecosystem. Each episode is a discussion with our guests based around 3 core questions that are shared in advance. Today, I'm joined by Jacob Miller, co-founder of Opto Investments. Opto's mission is to bridge the gap between private markets and the global wealth community, giving RIAs better access to asset classes such as private credit, venture capital, and infrastructure to help their clients diversify portfolios and reduce risk. Jacob co-founded Opto alongside Joe Lonsdale and oversees the firm's advisory services program, designing investment frameworks for RIAs serving high net worth and ultra high net worth clients. Jacob, thank you so much for being here.
Thanks for having me.
I'd love to start with just a brief background on yourself and maybe what the founding moment was for Opto.
Yeah, of course. I founded Opto a little over 5 years ago now, alongside Joe Lonsdale, one of the founders of Palantir, founder of Adipar, runs 8VC, which is a top quartile venture firm out of Austin and San Francisco. Prior to founding Opto, I was an investor at Bridgewater Associates, Ray Dalio's macro fund. So lockpicked the golden hedge fund handcuffs in late 2019. Ended up also being a good trade because I was back home in Northern California when everything locked down. Got to spend some time outside and got to meet Joe Lonsdale, through a mutual friend. He'd been thinking about a similar set of issues, but really from the allocator side, seeing as chairman of Adipar just how rare it was, really across entity types, family offices, private banks, RIAs, how rare it was to have a really robust and efficient way to access private markets for clients. So we put our heads together for the bulk of 2020 and officially launched right at the start of 21, made our first engineering hires. We are a true fintech, but in that we do have some real talent on the investment side, but we are all builders first and foremost. That primarily means for us setting up custom private market programs. Hey, we're going to create the Haber Growth Fund and Haber Income Fund. These are both going to be $50, $100 million funds. They're going to hold 10 managers plus co-investments. We'll do one of those a year. But we can also work with firms to set up just a single name SPV program. If they want to do 10 co-investments a year, but do that in a structured way, do that in a way that's really easy for clients. And so work with groups across RIAs, family offices, private banks, other wealth management groups to really bring this to life and use technology plus our team to give people the access and confidence they need to make this a key part of their business.
Who would you say is sort of the core client base? It sounds like there's a couple different potential modes of distribution for the business, but I'm curious if you guys have identified sort of a core ICP on the distribution side, maybe either in terms of sort of AUM that the firm may have, or sort of category of wealth manager type that you serve best today.
Yeah, I'd say at a high level, it's any group that takes and they don't technically have to be a fiduciary, but takes a fiduciary approach to working with their clients. So, to date, we don't work with firms that work on more of a commission-based model. Level down to your question, our focus definitely tends to be on firms with a high concentration of qualified clients or above. And so that's one step below qualified purchaser. So 2.2 overall or 1.1 with the firm. If you're talking about committing to an illiquid structure, you need to have the illiquidity budget to see that through. So we tend to work with firms that have enough clients with that illiquidity budget for this to make sense.
Let's dig into that, if you will. I'm curious the reasons why Opto as a firm prefers sort of the private drawdown structure relative to evergreen funds.
How long does it generally take to know if an investment idea was a good one? I think the answer is generally a full business cycle. If you're going to go build a factory, how will you know if that was a high ROI? Well, you got to build it. You got to get it up and running. You got to hit scale. It's going to take 5 to 7 years. But at the same time, that permanence of capital is a real risk reducer for firms trying to build things. Second is, the fees that get involved in turning something that is illiquid into something liquid. So there's additional regulatory and board costs in setting up any registered product. You have to maintain a cash buffer. That's just cash drag that you're paying management fees, expenses, and maybe performance fees for. The person allocating will generally be more constrained. They'll have to pick deals that they think match that liquidity time frame. They won't look at every deal or necessarily trying to pick the best deal. They'll have to pick the one that matches the liquidity profile they need. And so when you partner with a traditional drawdown fund, they usually have a 4-year, roughly investment period. If now's not the time, they can be patient and wait and not call your capital until they're ready. And then fundamentally with these structures, you just have this, what essentially amounts to counterparty risk of what happens when a bunch of people head for the exit is the easiest thing to sell is the best security. So they do that and distribute, and then you're left with lower and lower quality securities. And if you are the last person to figure out that there's a problem, by the time you try and get out, there'll either be a gate up or you're talking about selling the remaining securities that are going to have significant markdowns because they were not the easy ones to sell. Now that said, structures are just structures. You can use them well, you can use them poorly. We do help clients build their own tender offer funds where the underlying tends to be the traditional drawdown structures, but they can offer some form of periodic liquidity to clients. But with tender offers, I think about it like as a dividend versus a bond payment. Of if you miss your interval payment, that's a big problem legally. If you elect not to hold a tender one quarter, investors might be a little bit annoyed, but you haven't violated any terms of the structure. And so it's better matched to the fundamentally illiquid nature of private markets.
That's super interesting. And I think broadly agree that tender offer funds in the construct of 40 Act funds have a better match to the underlying illiquidity of the assets relative to an interval fund. I guess I'm curious your perspective because, in the market today, you're seeing a lot of the larger GPs across a couple different asset classes, private equity, credit, infrastructure, really leaning into the 40 Act fund space, into these evergreen fund vehicles, in particular as sort of the, call it vehicle of choice to reach the wealth channel, to reach RIAs and their end clients. And I could be wrong on this, but I think one of our learnings is that dynamic, the dynamic that creates in the market is in part that advisors are able to allocate to a sort of large brand name alternative asset managers evergreen fund with a lot less thought or concern or sort of risk on the part of the advisor than maybe allocating to a product in the mid-market or just a smaller brand, a smaller manager with less of a brand name, right? There's sort of the old adage of, no one gets fired for investing in Blackstone. And so I guess I'm curious from the Opto perspective, considering that you're focused more on the more sort of drawdown vehicles, less on the evergreen fund space, but still targeting sort of the fiduciary RIA network as a distribution network that you work with. How do you approach explaining private market allocations that are not the top tier or top brand name managers to clients that you work with at Opto?
Yeah, so a few things there. One, given some of the news, and I won't name names here, but we all know who I'm talking about in the BDC space over the last 6 months, I'm not sure that adage 100% holds anymore. And what looked like this, blue chip large manager is having the more stress than many small drawdown credit managers we work with. I think the important thing is that size and quality are not the same thing. safety, maybe, or at least from a reputation standpoint, yes, no one gets fired for X manager. But when we look at the data, the difference between top and bottom quartile for funds below $1 billion in VC or private equity, say, is between 3 and 10 times, depending on the year, the difference in funds over 4 or 5 billion. As you get bigger and bigger, it becomes harder for me to believe that you are delivering anything besides private market beta to some extent. If you're party to 30% of real estate transactions in the market, that sounds a lot like the market to me. But we're looking for people who have unique information, unique access, and have identified where they can, stick to their guns and outperform. And if you can do that consistently, and you don't have to be top quartile every time, but if you're not bottom quartile and you're top quartile 50% of the time, you're talking about pretty serious improvements in returns. The difference between top and bottom quartile in long short public equity is 3 to 4%, depending on the year. In venture capital, it's 25 to 30%. And so if you can sit in that top quartile bucket, you're talking about significant outperformance and diversification as well. We look for the places where real work, real diligence, real operational excellence can lead to outsized returns.
That makes sense. And I guess it leads me to think about sort of Opto's business as a whole. Obviously, there's a technology side, the platform, the experience, digitizing as much of the sort of bespoke workflows as possible. But then it sounds like there's also really a heavy emphasis and focus on sort of the asset selection and due diligence side as well. And then, I would say naturally working with clients that you're on the distribution side of your platform that, helping explain these products, sort of building these bespoke programs. Where do you spend most of your time in sort of those three different categories? And what do you think of those three, and maybe there's more that I'm missing, or sort of the core differentiator competency for Opto as a platform?
But I'd say the most important piece of this, or perhaps not most important, but the thing that allows us to do everything else, is a choice we made to never accept payment for distribution from GPs. And so we, unlike most of our peers in the market, will not get paid to distribute a fund. That lets us be unconflicted in our advice. It lets us be open architecture. And so while we do maintain a material sourcing function, if our client finds the best idea, we don't have any monetary reason not to choose that. It's totally collaborative. And I think it lets us build the best technology. If you are being paid by a fund, I would wager that you're not going to build a portfolio construction engine that doesn't recommend that fund. If you are paid by your clients to succeed from an investment perspective, you're going to build the best portfolio construction engine. And so everything else flows from that choice that we made. And look, our revenue would probably be 15 times higher today if we did that. But I think it'd be 15,000 times lower in 10 years because we're building this the right way.
Maybe looking out into the future, 5-10 years from now, what do you think private market allocation looks like? I'm curious in particular your thoughts around sort of this convergence of private and public, the creation of model portfolios that are bringing private and public into one under one roof, and more, I would say, public market distribution platforms and custodians getting involved in private markets as well. So zooming out 10 years or fast forwarding 10 years, what do you think private markets allocation looks like, and what role do you think Opto will play in that future?
Yeah, I'll start with maybe a bold claim, which is that alpha will never be democratized. People talk about democratization a lot in our space. Some amount of that is a good thing. Too much of that without the right education could be a dangerous thing. But regardless, alpha is a scarce commodity. It's hard to identify. It's hard to diligence. It's hard to maintain. I think private market beta is a very good thing. And there's a lot of fundamental reasons to believe that private market beta across asset classes should be diversifying to its public market counterparts. You have different investor bases, different segments of the economy. Right now, if you wanted to, in a CAPM way, capture the U.S. economy, you can't do it. Too much of it is private. And so you're inherently taking a bet that you might not want to be taking. What I think needs to happen is people need to be more honest about what is alpha and what's beta, and beta needs to cost what beta should cost, which is generally not what alpha costs. Now, private markets are harder. I'm not saying we're talking about a 5 BIP or even a 20 BIP ETF here. But when I look at 2 and 20, 1.5 and 15, even 1 and 10 for beta, I think that's overpaying. And, our goal is over time to be able to present a, clear and auditable view of what we think, private market beta looks like. At first, maybe just to use as a benchmark of, hey, am I actually getting what I thought I was going to get out of private markets? But eventually, could be an investable index. And, I think that's what belongs eventually in 401ks and other forms of mass distribution. Don't pretend this is alpha. Don't overcharge people who don't understand what that sentence even means. But give them something that is diversifying, that might have a little bit more return potential because of the illiquidity premium, but do it in a safe way, and a way that's not kind of taking advantage of the gaps that exist today.
That makes a lot of sense. Maybe along those lines, what do you think is the biggest mistake that RIAs or potentially self-directed investors, although I think primarily private market distribution is still through the RIA channel. What do you think is probably the biggest mistake that people make when allocating to private markets for the first time?
It's a good question. One that comes to mind is thinking about the deal versus the goal and portfolio. Sometimes a shiny object crosses our desk, and it might actually be a great opportunity, and you just want to do it, and clients are excited, and it checks a box. That doesn't mean it's not a good investment, but if you don't go back to, what is this client's goal or this model portfolio's goal? What is their liquidity budget? What are the range of outcomes for this? Like, it could be a huge performer, but have liquidity later than you expected, who is not able to do the goals-based things they wanted, buy a house, fund their, children's education, commit to philanthropy because of a misjudgment there. And so, especially if you're going the drawdown route, you need to be ready to be constantly committing. That could be through an annual vintage program. It could be deal by deal if you want to take on that work. But, the way these work is you're not, you might allocate or commit $1 million today. You're not going to be fully called for 3 or 4 years. By the time you're fully called, you might already be getting distributions. So you never hit that $1 million target of exposure that you had. It's almost more like a muni bond ladder in some ways, which is the reason people pay providers to do that for them. You're always in market, and that's both good. You get vintage diversification. You're not overweight any one valuation point. Time when a certain sector was hot or whatever, you're going to be allocating every year. And the flip side is you're going to be allocating every year. You got to be ready to do that.
Jake, where can people find you if they want to learn more about Opto?
I'm on LinkedIn, and our website is optoinvest.com. You can schedule a demo straight from there, learn more about us, and reach out if you're interested in what private markets can do.
Amazing. Well, thank you so much for joining me on Capital Connect. This was a pleasure. I really enjoyed the conversation.
Too.